Yeah, all that asset management, diversification, that's for idiots.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing.
Much of what is taught in modern corporate finance courses is twaddle.
Hey guys, what's up? Welcome back to The Impeccable Investor. 9 out of 10 times people explain the diversification of investments as not putting all your eggs in one basket and from a distance. It does seem like a smart strategy to avoid losing all your money by spreading the risk. However, the biggest investing faces of the world disagree and think it as a choice for the idiots. Let's look at why Buffett, Cuban, and Munger hate diversification. Lack of concentration. Most people come into the investing game with a nervous heart and small amount of money. Therefore, spreading it across many industries or types of assets is similar to spreading a spoonful of jam across 8 slices of bread. Not enough. If an investor is starting small but decides to spread their money, they will have no concentration of investment dollars when the value of stocks rises. The gain will be much smaller because the investment money has been spread too thin. It is so much better to buy right and buy deep, meaning you analyze a company and when you know it well, invest more in it instead of fantasizing about minimal risks and damaging your chances at a higher profit. According to the leading investors, diversification is for the lazy. And if you want to be lazy, the best way to do so is by investing in an S&P 500, which allows you to invest in trusted companies without doing much research. Your financial success is dependent on more stocks in the fewer scrutinized baskets instead. Shield for ignorance. Buffett says he sees nothing wrong with diversification if your financial goal is to stay average and sustain your job. He gives an example of Coca-Cola and reiterates the fact that fortunes were not built from 50 or more businesses, but investing in 1 or 2 fantastic, well-analyzed ones who were resistant to the vicissitudes of the economy and stock market. The investors mentioned that whatever is taught in finance classes is impractical and utopic, and they can assure that the risk is piled up as you increase the number of businesses you invest in instead of decreasing, which is very contrary to popular belief, but stands true. Buffett even went on to say, if you really know businesses, you should not know more than 6 of them. Investing in volatility. Cuban blatantly called asset management through diversification a practice of an idiot and went against the conventional practices of investing very boldly on the camera. According to the modern portfolio theory, increasing the number of stocks in a portfolio reduces the amount of risk involved and maintains a well-balanced portfolio. Cuban and others of his likes have repeatedly mocked the theory and have favored volatility in its opposition. If you over-diversify, you would not lose much, but you also won't gain much. Cuban likes to take educated risks because that is what makes him stand out from the millions in his field. Market crashes are a gigantic nightmare. Reducing risk is a psychological decision and not one related to investing. Buffett, when asked about him being worried about a decline in stock market returns, answered that he is not nervous because he sees opportunity in those times, an opportunity to enhance the portfolio and buy more. However, imagine spreading your money in 20 different businesses and facing a financial crisis of 12 years, eagerly waiting for the stocks to go back up. Sounds like an endless nightmare. The biggest takeaway from this advice is to overcome the emotional side of investing and learn to trust your knowledge and the nature of businesses enough to be able to make the conscious decision of putting the eggs in a single or maximum amount of 6 baskets and then taking regular and good care of those baskets. It is important to remember as an investor that a diversified portfolio will not save you from the unprecedented panics of the likes of 1987, 2002-02, and 2008-09. The risk will always hover, so instead of avoiding it, learn to manipulate it. Too complicated to handle. Staying on top of your investment is essential if you want to take your investment seriously, and that requires time and good management along with a detailed analysis of the business. Putting your money in 50 different businesses or multiple mutual funds is a rookie mistake and can cost you your potential fortune. Many investors include so much asset to their portfolio that at a certain point they do not even completely understand what's in them and the risk or boons it carries. A wise thing to do would be adding as much as you are able to add to handle despite the advice you receive from professional financial advisors who will tell you to diversify your portfolio to the max, which will end up inflicting more risks and harm in the future. Concentrate your investments wisely and be patient with them. That is what the biggest investors in today's era like Buffett and Munger believe in, at least. Bad investment vehicles. A majority of investors who believe in over-diversifying their portfolio use investment vehicles such as mutual funds or index funds, which offer a focus on short-term trading rather than value in the long run. Buffett and Munger hate the idea of it as these funds underperform and have a pattern lower value in the long term. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss any of our videos in the future. Also, watch the 2 videos that are on your screen because I'm sure you'll love them. With that, I'll see you in the next video.